Welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Aabha Bakaya, and our guest on the show today, Nikhil Kamath, co-founder of Zerodha and True Beacon. Nikhil, great to see you again, and thanks for joining in. Before we talk about the market, I want to talk about the one stock we spoke about in our previous conversation, which was last year, about a year ago exactly. But it was Zomato, and you said there's no way you would be buying that stock at 125 and 130. Well, the stock has lost 75% of its value now. I mean, you would have seen it coming, but how do you approach it now, and in the light of the complete collapse in that name?
Well, it's a hard thing to say, Udayan, but I would personally probably still not buy it. The path to profitability does not seem very clear. And the acquisitions that they have done in the last 1 year, I don't know when the rewards of that will actually start coming through. But at the current juncture, I probably would not be putting my neck out at buying.
Okay. And how are you reading this pullback in the market? I mean, is it just another spectacular bear market rally, or is it something more than that in your eyes?
Well, from a broader perspective, I think it would be fair to say that the issues have not gone away. Be it with slowing growth, be it with inflation, be it with geopolitical tensions that we have across the world, and things like crude and commodity prices generally being significantly higher. So the problems which took the market down in a way, or they corrected that 20% when they did, the problems really haven't gone away. So it would probably be fair to assume it is a bear market pullback. I've been tracking FI numbers, even though they might have bought in the last couple of days. Overall, the trend still largely seems to be that they're selling and taking money out of India. So I wouldn't read too much into this rally which we have seen over the last week or two. I think we need to wait and watch when the problems actually get solved before we take a more structural call on the market.
Is it your view then that the markets might go back and retest the lows where we started this rally from? I mean, is that very much a possibility in your eyes still?
When I look at multiples and valuations compared to our own historical average, where we sit today is still fairly expensive. So one should not be surprised if the markets were to go down and test, whatever that 15,000 point that we tested in the last correction. The question, I think the bigger question here is what happens to growth going forward? How high do interest rates have to actually go before inflation is contained? These are tough questions, the answers to which are not very easy to fathom. So I would really wait for the cycle to play out. I would wait for all the interest rate hikes that might come our way, see what happens to growth then, and then take a call.
Nikhil, you've always tracked, the backdrop of the geopolitical tensions and how it impacts some of the world's largest economies very closely, and talked about US being such a big part of that. Given the current environment and the fact that things keep shifting, do you see more money moving towards the US or out of it?
Well, it's a very interesting thing, Abha. I think the share of US in world trade, albeit organically, is bound to go down. A lot of the things which are happening across the world, be it us buying crude in rubles or, China and Russia doing more trade, I think it is invariable to a certain extent that this trend will continue, that the US's share in world trades continues to go down. The question is, will there come a point when their status as the world's currency, or the reserve currency that the world uses to store money and trade, will there be a real challenge on that? Personally, I hope that happens, because I feel like it will allow room, it will probably create a vacuum which will allow for many other economies across the world to thrive. And I think the dominance that the dollar has held for as long as they have, it would only be, it would be good for markets across the world if it is challenged in one way or another. So I am more critical of America than I am of India. I feel on a relative basis, the opportunity and the story, the India story is probably, uh, I would look at it more from a filter of optimism, the India story. The one thing that the US continues to do is be able to attract talent and innovate faster than the rest of the world. And I think that is incredible. I think it's a big problem for us if we continue to lose talent to America in the manner that we have in the past. And that's something that we should really focus as a country to curtail and prevent that our smartest minds or some of them are moving out of the country.
You spoke about FII flows earlier, Nikhil, but let me ask you about what you're sensing. I mean, because you're also the co-founder of Zerodha and in a great position to tell us which way the wind is blowing on the retail HNI front, and also with True Beacon. So, do you sense caution there after the performance of the last 6 months, despite this rally, or do you sense a lot of confidence and exuberance?
So, Udayan, the regulators did a great job in culling leverage before the correction happened. If I have to draw one difference between crypto markets and equity markets, I would say the leverage in equity markets had gone down a lot, not by choice, but by virtue of regulation. So people really in the last 20% correction that happened, unlike a market where you could, lever 10 times or 5 times or whatever, I don't think the pain has been that bad. I don't think people really had to deal with too many margin calls or positions were cut like you would have witnessed in the previous correction, maybe 2008 or 2000 or the prior big corrections we have witnessed in our market. So the overall sense of optimism still remains. I'm here talking only about the 1-2% of the country which kind of has financial market exposure. On a larger level, there might be a lot of pain with inflation and unemployment. But for the topic of this discussion, focusing on the equity market alone, I would say the pain has not been too much, at least not in the last correction from 18,000 to 15,000 change that happened.
But what about people who are not traders, Nikhil? I mean, those who do not dabble in the futures and options segment, but actually have been putting a bit of money to work as a medium-term investment through mutual funds or other vehicles over the last 2-3 years. I mean, that portion of inflows has actually been steadily growing. How is that money positioned now after the lackluster performance of the last 1 year?
Well, we might have had a slow 1 year, but I think when you step back and look at it from a 2-3 year perspective, during the pandemic, when a lot of new retail actually came into the market, a lot of them are really still sitting with large, hefty gains. Pre-pandemic, when the markets just at the beginning of pandemic went to 8,000, 9,000, a lot of new retail interest started coming about and a lot of new entrants into the market. I don't think they would be too perturbed, like if they bought at 8,000, 10,000, 12,000, watching the markets rally 70, 80%, a 20% correction would still not be hurting them. If you were to talk about the people who came in the last 1 year alone, even then, I think at peak, we were 18, 19% down. I don't think that is significant enough to make people cut their positions. I'm talking about equity delivery positions or book losses. I think they remain hopeful and optimistic of the future. But retail generally is always bullish, Udayan. I don't think they look at it any other way. So more often than not, people buy into the largest story of India. And, to be fair, our markets have gone up 11, 12% compounded in the last 20 years. So I think that memory is a lot more prevalent than this tiny 20% correction that we might have witnessed.
Sure. What's looking attractive, Nikhil, if we take a look at the breakup segment-wise and, what perhaps is now looking fairly valued, where do you feel we'll see the maximum return?
Well, I think the GDP per capita, the $1,800, $1,900 or maybe $2,000 per person number I'm making the assumption that that will go up. I'm not saying, we will go up to the $10,000-$12,000 like China right away, but in due course, I think that number will go up. When that does, I feel like anything around consumption should probably do well in India. More people entering the middle class. So I think like FMCG companies are interesting. I like multiplex chains. I feel like post-COVID, the restaurant chains and the hotels will probably do well for the next year or two. I'm a bit averse to the commodity story. I feel like that has played out, and I would probably stay away from the steel companies and all the commodity plays there out there. I continue to remain extremely optimistic on gold. How much money the West has printed in the last 2 years, and the number might be like 10 or 20 trillion dollars. I feel like it inherently makes a use case for gold to become more relevant. So that one commodity I remain bullish on. Yeah, but I think largely the broader theme for me is middle class increasing in number and play consumption as a story.
Do you have a view on the currency, Nikhil? Because that's been a little wobbly, more than a little wobbly. And how does it tie in with your view on the export sectors, IT and pharma, principally?
Well, the trade deficit is a problem. It seems to be going up, right? Like the $25 billion a month number. If nothing is done to kind of like change that around drastically, 1 year, 2 years down the line, it will become a significant issue, and we would all have to face the brunt of that. Currency, again, to be fair to the government, on a relative basis, I don't think we have done as badly as many other currencies, emerging economy currencies across the world. So only when I compare, the rupee to dollar does it look so bad. When I compare it to the euro, the pound, the yen, very many other currencies, if the world were to truly open up and we can trade in these currencies, I don't think we have done so badly. I don't see the currency thing as too much of a problem. I know it looks bad when it is at 80, but I think it brings with it certain advantages and disadvantages. While we are running a trade deficit and we're importing as much as we are, it's probably going to hurt us more in the interim. But the key there has to be, for that to turn around. One big hope there could be if India becomes the first country to transition out of fossil fuels, we seem to be aptly located from a geographical standpoint to take advantage of renewables like solar. And India is gifted in so many ways when you look at it from that standpoint. I feel like if you were to take out the crude component from the deficit and we do a bunch of different things differently and the trade deficit number goes away, I know it won't happen in the near future, but with time, I don't think the currency will be too much of a problem.
Okay. Now, there are two areas of the market which a lot of, veteran or old-time investors are generally cautious about. One is the whole digital system. I mean, we spoke about Zomato, but generally the whole cluster of stocks, though they have corrected very significantly. And the other is anything which is from the PSU basket because of all kinds of issues that we both know about. So, of these two, if you had to choose today, wade into either digital post-correction or PSU in the light of the fact that things have improved a bit, which one would you gravitate towards?
I would say neither, Udayan. I feel like government and enterprise do not go hand in hand. There is a reason why capitalism has thrived across the world. You could take the example of Air India or 100 other companies which the government managed. And for the lack of a better word, I think by experience has taught us that necessarily is not the best way to run a corporation. So I feel like, there should be more divestment. I feel like a lot more privatization needs to be done, if not for any other reason, to make our companies more competitive and more efficient in the way that they're run. So I don't think I would pick either theme, especially on the digital side. The listed companies on the stock markets, I still, to date, I know they've corrected a lot. But for a vast majority of them, I still find it hard to figure out how they will become profitable and when they will become profitable in a significant manner. And for that reason, I would probably shy away from both sectors.
All right, fair enough. In the beginning, Nikhil, you talked about how people start to have to get used to more moderate returns. What do you feel is a year-end expectation? Because it's been so difficult to really predict the trend. Markets have been so volatile of late.
Yeah, I mean, Abha, I think it's one of the least likely things I'm able to do accurately is predict what will happen tomorrow. I would be fair in saying that nobody truly can. But where we are today, we are relative to our own past expensive. So to have one slow year after the kind of year we have had last year and the year before that, I think would be par for the course. It would probably be a good thing to have some stability and kind of wane away from the extreme volatility we have witnessed in the last couple of years. I wouldn't think that's a bad thing. In the long term, over a 5-10 year period, if we continue to deliver that 11% or 10% a year kind of return in the equity markets, it would continue to be a very, very attractive place for people to invest. We have the advantage of lower taxation. Equity investors, LTCG is at 10%. By virtue of that and that 11%, if you compare it to other asset classes in India today, real estate and all the other avenues that one traditionally invests in, equities still remain very attractive. And I think that would be a good place for us to sit at.
How do you see the real estate cycle? You just mentioned it, Nikhil. I mean, how does that look? Because it seems to be stabilizing and making a comeback over the last year or so. Do you see a major real estate cycle play out in the next few years?
So, Udayan, I'm extremely bearish on real estate for many reasons, as I have been for a long time. I rent the apartment I live in. I probably own only one house where my parents live. Many reasons for that. I think demographically, whenever I spoke to a lot of real estate developers are people I know, and whenever I've asked them, is real estate fairly valued today, they all seem to truly believe that land prices can never go down. We in our generation are kind of jaded by the last 30-40 years of India, where we have seen a one-way up move in real estate per se. If you were to use the argument that there will always be more people and finite land, I think our demographics are kind of pointing in the other direction. If you look at the last survey numbers that came out, most states in India are under the replenishment rate when it comes to, the fertility rates of today. Every couple has to give birth to 2.1 kids for population to plateau in a way. But that number has gone down below 2.1 in many states in India. So that old adage of, talking about how population is going to be such a problem and India's population will be X in 2050 and Y in 2080, etc. I think that no longer holds true. What would probably be more likely is a situation like Japan, where suddenly, because fertility rates dropped so fast, we would have an aging population which the rest of the economy has to support, and that change might happen very quickly. One reason for why I'm bearish in real estate is that. And things like, work from home, many people might not buy into work from home, but 90% of our company, we work from home, and we've realized that 1 hour or 2 hours that most people would save in traffic in metropolitan cities, it brings in so much more efficiency and you save so much time. And, ancillary benefits, like it's better for the environment, you're not burning as much carbon. There are so many advantages to that as well. Now, for many, many reasons, I'm bearish on real estate. The biggest of them being the fact that real estate developers do not believe that land can ever correct is scary to me. So when it does, I feel like that correction will not be a reasonable number, but it would be stark. And there is Also, I believe there is more leverage in that industry than there should be.
Nikhil, always a pleasure to hear your thoughts. Thank you very much for your time today. Take care.
Thank you, Udayan.
If you like the video, do like, comment, share and subscribe.